We have the Federal Reserve in America officially announced they're going to do quantitative easing for the first time in really 3 years, with the Federal Reserve really giving us a tailwind until we hit a recession. We could see some of our favorite stocks go up 40, 50, 60% in the next really 6 months. So let's begin by going through the announcements the Fed gave this morning. Yes, we did have a 0.25% cut now to around 3.75% in terms of the Fed funds rate. This interest rate really prices extremely short-term loans, anything up to really a few months. So for example, that could impact your savings account, that could impact credit cards, and things like US 1 month and 3 month treasuries. The Federal Reserve is trying to tell us they want lower interest rates in the next couple years, and they need to try and convince the banking system, but also investors who really govern all of these interest rate moves. They're trying to tell them, look, we need this to go lower in order to avoid an economic slowdown, a recession, and the Federal Reserve really has no power over these investors. It all comes down to economic growth and inflation, but more on inflation and interest rates a little bit later. The Fed also came out and announced a change to their money deletion and money printing schedules. Over the last couple years, we've had around $40 billion of money deletion from the banking system. So think of this as the reserves or the collateral that banks use to give out loans to everyday people. So as the Federal Reserve was deleting $40 billion every single month, that just meant there was less collateral in the system to back up these everyday loans. But the dirty secret that the Fed never talks about is they had a spare roughly $2.5 trillion in the facility called the reverse repo facility. That cash was generated during COVID, and they just printed way too much money, and that spare cash was slowly depleted all the way from 2022 until pretty much just earlier this year. So the Federal Reserve signaling to us that they were deleting these assets off their balance sheet. They were trying to reduce really the lending power in the economy, reduce inflation. All of that was really a load of bullshit, because all they were doing was deleting the spare cash they had printed back about 4 years ago. And then literally within the month of running out of these spare funds, the Fed signaled to us, look, we're probably going to stop doing this money deletion by December. And then lo and behold, they actually flip fully in reverse. They've actually gone from sucking up liquidity, deleting it from existence. Now they've actually turned on the spigot, and now they're starting to print money. That's how quickly these guys have turned on a dime. So within a month of running out of money, the Fed is now printing $40 billion per month at this rate. That just floods the banking system with excess liquidity, the exact opposite of what they were trying to do a few months ago. So we have this fierce battle going on between the fundamentals of the economy, but also we have Jerome Powell and the Federal Reserve trying to force lower interest rates on investors. And we can see this battle play out with the US 10-year bond yield. Now, this is the minimum interest rate for more longer term loans. Think of mortgages, car loans, and you get the final lending rates by plussing on a risk interest rate on top of this baseline. But I can see here we've been really locked in a battleground for the last couple years, and investors are not convinced of a recession. If that was the case, interest rates would plummet, but they are also not certain about inflation. If inflation was going to spike up higher to 5, 6, 7% like it did back in 2022, then these interest rates on the 10-year would be going up towards 5, 6%. Regardless, in terms of the average of the whole US economy, if we continue seeing inflation actually moderate from these levels, maybe go back down to 2%, wage growth continue to hover around 4%. If anything, we're slowly going to grind higher to a better US economy, and that's great for things like the stock market. There's been so many different companies, especially those in more of the traditional sphere. Not every single company is doing data centers and AI. Maybe those companies are about a quarter of the total stock market weighting. We still have 75% that are really dealing with customers in the real world, and we can see how those companies have been faring over the last 5 years. For example, I like to look at General Mills. It's a food-based packaged food company. They also deal more in pet food these days. They've been struggling really hard over the last 5 years. You've lost 23% in terms of your stock price. Your dividend yields probably broke you even over that time. But either way, that is nowhere competing against, your Facebooks, your Googles, your high-tech Nvidias. And it's taking a little snippet out of the recent earnings report. We see here they're trying to bump up prices every single year, roughly around 3%, but the customers are just not having it, where the average volume, for example, in North America retail, so, buying packaged food off the shelves, they have seen volumes down 16% over the last year. But what that is doing to the average company, which does typically have a dividend, we've seen them get more and more attractive over time. The dividend yield on General Mills is roughly about 5.3% right now. Maybe they go down to 3% if the Fed can pump more money into the system. If they can buy up US treasuries, that lowers their interest rate. If they can lower the Fed funds rate and communicate to the banking community, we need to have interest rates lower. If that succeeds, then your dividend yield on these types of traditional companies is just going to look more and more attractive. Only way you get dividend yields down is if you actually buy up that stock. You could see a company like General Mills go up 30, 40, 50% in that type of environment. And that's even when the fundamentals of the company, forward P ratio of 12, yeah, that's cheap, but the company's just not growing that much. Switching the story to more companies that do not have a dividend yield, we really have the picture of the discounted cash flow model, or DCF model, that Wall Street likes to price their investments. Now, they really just take the cash flow or the returns of companies and they divide that by the discount rate. Now, the discount rate is basically saying we're going to compare this against a risk-free return. Really, that means we're dividing returns against US 10-year bonds. And if US treasuries are going down in interest rate, then automatically the same company is actually worth more in Wall Street's eyes. And this is where we start to look at my darling here, Facebook, my favorite company right now. Yeah, they're growing profits really strongly, 15 to 25% over the next couple years. I've crunched my own numbers in yellow, showing a forward P ratio of 18.8. We could get a 70% return in stock price, assuming a pretty standard economy. But none of those assumptions take into the fact if we have a US bond yield drop from 4% down to 3%, then most of our companies just got 20, 25% more attractive in Wall Street's eyes. And we could see those investments, instead of going up 70%, they'll be more like 100% return. So when we look at the model portfolio here, I'm still holding some pretty high risk companies, and even from pretty elevated price levels today, stimulating Fed plus no recession tells us we've got a green light to take on some more risk. If you enjoyed today's video, please subscribe, but also I've got 2 more videos just like this one here on the screen. I hope to see you guys there next.